So you're welcome to Positive Economics Chapter 4. Today we're going to talk about the market economy. So when we talk about the market economy is an economic system in which is decision making about investment, production, distribution to consumers are guided by the price signals created by the demand and supply forces. So that takes us to talking about who consumers are, consumers' role in the market system. Introduction. We will start our analysis of microeconomics with an examination of the factors that affect the purchasing of goods by the household. The household is any group of individuals whose purchasing decisions are made by one person. We refer to this person as the consumer. We call them consumers because they are the ones that do the purchasing. So they purchase goods and services. So what is the role of consumers? Consumers determine what goods and services are produced. So consumers are the kingpin of every business. Therefore, if we have to sell as a business, we have to produce what consumers would really want to buy. So consumers determine what goods and services are produced. The consumer buys economic goods according to their individual demands, which in aggregate becomes market demand. Entrepreneurs and businesses observe these purchases and develop goods and services to meet these demands. So the role of consumers is to determine what goods and services that businesses have to produce. And how is it so? It is so because consumers will only buy what they want to buy. They will only buy what they think they deserve to buy or what their demands are. So it is important for businesses to make a research and produce these goods that consumers are willing and able to buy. Consumers provide information about habits, trends, and preferences. Sometimes people come up with new ideas that seek to disrupt, that completely change the market. For example, like earlier mobile phones, the smartphone incorporated a camera, a GPS satellite system, and access to the internet. However, how do you know that your product will be what people want, demand, and more important, would buy? Effective demand. So there's demand, there's effective demand. Demand simply means the ability and willingness to buy. Effective demand is when consumers are able to buy and they have the ability and willingness to buy and they actually purchase the product. That is effective demand. So entrepreneurs and business people carry out market research to ask consumers about their habits, trends, and preferences so that they can make products, offer services that meet the market need or want. Businesses will not be able to sell if the products or services they render or provide or produce does not meet the demand of customers. So if businesses do not provide goods and services that meet the demand of customers, they are unlikely to sell. That is why entrepreneurs and business people must carry on what we call the market research to know the trends, to know the habits, to know the preferences of consumers. The third one, consumer pay for economic goods that they demand. The consumer pays for the product they demand, which gives money to the suppliers, and we assume they are selling at a profit. Over time, the supplier can then buy more products, take on new staff and sustainable jobs, invest in new technology, give sponsorship money to good causes, develop new opportunities, and generate income for themselves. So consumers will buy these goods in exchange for money. So that means whatever goods that are being produced by businesses or producers, it has to be paid for by the consumers. So that's another role of the consumers. So that takes us to the characteristic of economic goods. An economic good is a product or service that commands a price, derives utility, and is transferable. We call it economic goods because it is scarce. And when it is an economic good, it means it needs to be sold at a price. And it has to bring satisfaction in the course of consumption. So to be considered as an economic good, a commodity or service must have the following characteristics. So what are the characteristics of economic goods? The price. It must command a price. That means whatever we call economic goods must be sold at a price, because those goods that are produced that are economic goods are from the factors of production, which are scarce. So it must command the price. The good must be scarce in relation to the demand for it. In essence, there is not enough of it to satisfy the demand of all those who want it. For example, fresh air is not scarce. It is plentiful in supply. So people are not prepared to pay for it. It does not command the price. On the other hand, no textbooks are freely available for students who study living certificate economics. So this book commands the price. For economic goods, because they are goods that are produced from scarce resources, they must command a price, unlike free goods, which do not command the price. Utility. When you talk about utility, we're talking about the amount of satisfaction that can be derived from the consumption of any commodity. So whatever we call economic goods, it must be satisfying. When in the course of consuming it, consumers must be satisfied. Utility is the amount of benefit or satisfaction derived from the consumption of a good or service. The good must provide the consumer with some feeling of satisfaction. Consumers will not demand something that does not provide satisfaction. For example, this textbook offers utility as it helps students to study the course material, understand the context with case studies, and prepare for an exam. So whatever we call economic good must bring about satisfaction for consumers. The third characteristic of an economic good is transferable. Ownership or benefit must be capable of being given from one person to another. After your living certificate, you can give this book to a younger sibling or bring it to a second-hand shop to sell it. Therefore, it is transferable. However, you cannot give your knowledge of economics to them. That is in your head, and they will have to study for themselves. So we call it an economic good because it is transferable, which means it can be sold. It has a second-hand value. It can also be sold. It can be given from one person to another. That's an economic good. So that takes us to the assumption concerning consumer behavior. Assumptions concerning consumer behavior are this. A consumer is an individual who makes decisions whether to buy goods or services. In economics, we make certain assumptions about consumer behavior. Call them consumers because they make decisions about buying a product or service. So what are the assumptions about consumer behavior? One, it is assumed that consumers have limited income. So the first assumption is that there's limited amount of money that is available for consumers to spend. So that means the consumer's income is not large enough to satisfy all their needs and wants. Therefore, the consumer must choose between those goods they wish to buy. Two, it is assumed that consumers seek to get maximum utility satisfaction from that income, which is the equimarginal principle of consumer behavior. So that means consumers will spend their limited incomes in such a way that they will try to achieve the most satisfaction from the goods and services they purchase and receive the best value for money. The second assumption is that whatever consumers spend on, they must derive satisfaction from it. And the third assumption is that it is assumed that consumers are subject to the law of diminishing marginal utility. So the law of diminishing marginal utility states that as more units of goods are consumed, a point will be reached where marginal, which is extra, utility eventually begins to decline. It is assumed that as soon as consumers consume an extra unit of output, the satisfaction derived will start diminishing. So these are the three assumptions of consumers. It is assumed that consumers have limited amount of income to spend. It is assumed that consumers will always want to derive satisfaction in the consumption of any commodity. And it is also assumed that consumers are subject to the law of diminishing marginal utility. So in the next class, we're going to talk, and the last one, sorry, it is assumed that consumers will act rationally. I'm going to talk about a rational consumer. A rational consumer is a consumer that acts in a way that suits its satisfaction. So the consumer acts in a manner consistent with their preferences. For example, if the person sees an identical commodity priced differently in two shops, they will buy the good at the lower price. So consumers are assumed to be rational because whatever they buy based on their preferences. So in the next class, we're going to talk about consumer equilibrium. I think let's see if we can talk about consumer equilibrium now. Then we can, yes, let's talk about consumer equilibrium. Then in the next class, we'll talk about demand and supply. So there's consumer equilibrium. Equilibrium is a condition where there is no tendency to change. The consumer is in equilibrium when they follow the equimarginal principle, in essence, to obtain maximum utility. This principle states that a consumer must spend their income in such a way that the ratio of marginal utility to price is the same for all commodities they buy. So there's maximum utility. Maximum utility is achieved when the consumer is obtaining the same utility from the last cent spent on each good. So there's consumer equilibrium. If whatever consumers spend on is obtained, they can obtain the same amount whenever on each goods that they purchase. That is what we call marginal consumer equilibrium. And there's equimarginal principle or law of equimarginal returns. So the principle of equimarginal utility explains that the behavior of a consumer in distributing their limited income among various goods and services. So the equimarginal principle illustrates how consumers allocate their income in such a way that the last cent spent on each good will bring the same marginal utility. So there's equimarginal principle, which says that the last amount of money consumers spend will bring about equal satisfaction on any goods that they consume. So these are all about consumer behavior. In the next class, we're going to talk about demand and supply. Thank you.